so they can get an opportunity to ask you where you are financially right now. We want to understand everything there is about you financially, where you are right now, also what your investment goals are. What investment goals are in 10, 5 or 3 years. And it's our job to basically develop an investment strategy and a plan, basically a direction, a roadmap to get you from one place to the other. For that, financial planners charge between, 3, 5, 10 grand. We'll do it for nothing. The only time we charge is when we add value. That's the only time. If we sit down with you and work out that maybe our investment strategies aren't suitable for you, then we're not going to charge you anything for it because we've added no value. So you get that opportunity. It's free of charge at the end of the session. Past performance is not an indication of future performance. Well, who wants the next 2 years to be like the last 2? No one. Let's hope past performance is no indication of future performance. So this is a bit about my company. Talking about the premium portfolio service, the investment management side, insurance and superannuation. We do all of that. Offices in Sydney, Melbourne and Brisbane. As Megan mentioned, in the BRW, we're Australia's fastest growing investment services company. It's 2008, 2009, 2 years in a row. The reason I believe that's the case is because we're leading the industry in a direction of ethics and integrity. We're also nominated out of 1,600 companies, including BHP. We're one of 3 finalists for the Australian Business Awards. Out of 3 finalists, we didn't win. I'm not too sure whether we came second or third out of the 1,600. I'm still pretty stoked about becoming a finalist. We didn't win. The company that won, if you look at investing, what's another important thing? The focus at the moment for Australia, in Australia here alone, we are now apparently the most obese country in the world. Yes, we are fatter than Americans, believe it or not. I just got back from America. I can't believe that is the case. But apparently statistics show that is the case. So that being the focal point, what do you think the company that won the Business Awards is? You would hope that. Let's go to the opposite. Not quite McDonald's. It's a pizza joint. Crust Pizza. Anyone heard of Crust Pizza? Why are they so good? Because they're gourmet. They're meant to be the healthy pizza alternative. Since when are pizzas healthy? It doesn't make any difference what crap you put it on. If it's still got cheese and shit on it, it's not healthy. So I'm a bit disgruntled I didn't win. So 4 steps to investment success. The first point, these are my 4 steps. Know what you want. What you want when it comes to investing. Let's not just look at the share market at this point in time. What do we all want? Well, I think when it comes to the holy grail of investments, you want to have something that provides a high level of return with what? High return and low risk. If we can achieve both those simultaneously, then we've proved modern investment theorists completely wrong. Outdated. You don't necessarily need to take on high levels of risk now to achieve high returns. What else do you want when it comes to investing? Well, some people in the room, returns can come from 2 ways. Capital gains, or what's another thing? Income. Why would you invest in shares as opposed to property? Well, income, potentially. Well, how easy is it to sell property at the moment? It takes a fair while. Shares, most liquid form of asset class behind cash itself. So one thing that you're looking for in perfect investment may be liquid. What else? What would make an investment perfect? Well, what about property? Why would you invest in property over shares? Yeah, it's got less risk. What else is it? Is a bank going to lend you more on shares or property? Property. So if you're looking for an investment, leverage would be good. Or what Mark was talking about before is other people's money. What's a perfect amount of other people's money that you want to borrow? All of it. Okay, all of it. So we want high returns, low risk, income, liquid, leverage, other people's money. We want to borrow all of it. What else do we want as a perfect investment? Do you want anything else? Something that's easy. Easy, something that you can implement immediately.
Something that's guaranteed.
Guaranteed what? You've got no risk. In fact, okay, guaranteed. Low risk. Anything else? You don't want to be a rocket scientist. So something that's simple. What else? You're doing great. Sleep at night. How important is sleep at night? Sleep like a baby. When you trade options, you'll sleep like a baby. You'll wake up every half an hour in a sweat crying. If you haven't shat yourself, that's a good thing. Can you guys read all that? I hope so, because you're going to read it back to me in a minute. So first of all, you'll know what you want. This is a perfect investment list. When you know what you want, you can compare property or shares, or trading on the share market to investing on the share market. Only once you know what you want will you find it. This is a process that I did at 21 years of age. At 21, why? Because I wanted to enjoy all the pleasure associated with the share market without the risk. I didn't make an investment in the share market until I was able to overcome the risk. So first and foremost, know what you want. Second one, just model someone that's already achieved it. When it comes to investing, who do you want to model? Warren Buffett. Why pick anyone else? What about these guys? Hitting the wall. I assume that bloke there on the right-hand side, your right, is a professional. I assume people trust in him their money. This was the bottom of the market. This was the best buying opportunity there was. Front page of the newspapers, hitting the wall, hell of a day. And someone was following his investment advice. Like, have a guess. Do you think he was buying shares on that day or selling? It's amazing what the share market can do to people. The share market is a really interesting place. On Boxing Day, Myers, David Jones has a 50% off sale. What happens? Stampede. Which way? Like the doors are pretty much trembled because people are running in there to get bargains. Is that right? Buy more shit that they don't want. The share market. What happens when it's 50% off? There's a stampede the other way. The buyers have just bought. Even professionals are running for the doors. They can't wait to get out. Why is that? 50% off bargains to be had. And they're out of there. Here, quick, have all the quality blue chip stocks I just bought yesterday. And I'll give them to you for 50% off. Share market makes people stupid. Absolutely stupid. The reason why is because this is on the front page of the papers. What does that instill you with? Fear. Is that going to basically encourage you to stick to your long-term disciplined investment plan? Do you think professionals are exactly the same? And then you've got the benefit of leverage. Leverage is a double-edged sword. Unfortunately, many people from Storm discovered that the hard way. There's many people that had leverage. Market goes down 50%, they receive a huge margin call. Can't pay it, what does the bank do? Sells it all. So many people hit the frenzied sell button, not because they're fearful, because the bank's hitting it for them. That's a terrible situation to be in. They've lost all their assets, many have lost their own home. All of that could have been avoided. All of that could have been avoided if you followed the Warren Buffett investment philosophies. When you look at mirroring people, copying, these are not the people to copy. In fact, I've got another indicator where you can pick the bottom to buy and also pick the top to sell. I've called it the Koshi indicator. Does anyone watch Sunrise? Koshi, is he a genius? Best time to be buying, he was basically on TV saying, sell everything, quick, you've got to be, get out of the market. If you're in the market, you're going to lose your money. In fact, don't even put your money in the banks because they're the worst. Take the money out of your bag, put it under your pillow. It's the only safest place for it. Best time to buy. Top of the market when Koshi is saying, look, now's the time to be getting invested in shares. Sell. Sell. The Koshi indicator. It's a reverse indicator. Just do the opposite to what everyone else is doing. Because what dictates price? When prices are low, is there more buyers or more sellers? More sellers. So just pick at everyone else. When your neighbour or the people at the pub say sell, yeah, great, I'll buy it off you. 86% of people lose money on the share market. Just do the opposite to everyone else. Is that a fair amount of wealth that's left for the other 14% of us? Which one do you want to be? When prices are high, is there more buyers or more sellers? More buyers. So when there's more buyers in the market, what should you be looking at doing? Taking some profits maybe. Warren Buffett, the best time to be buying on the market, he decided to dip his toe in the water and bought $6 billion worth of a company. Now what did he buy? Goldman Sachs, United States Investment Bank. Of all the sectors that you would have thought would have been the worst to buy, that's where he invested. Why? Because he had the pick of any of them. He sat back and rubbed his hands and go, which one am I going to buy? Which one's going to be giving me the best terms? Goldman Sachs gave him great terms to inject his capital to that company. Now, 3 months later, does anyone know what the share price had done to Goldman Sachs? It was down 50%. Down 50%. In the media, Wall Street Journal saying Warren Buffett lost his touch. Warren Buffett should retire. Warren Buffett should basically die. He doesn't have what it takes in the modern era. Why was that? Do you think Warren Buffett sold? No, he was just holding back. He wasn't reading the business section. Who here in the room reads the business section of a newspaper? If you do, it's costing you money. Turn it over to sport. If you spend more time reading the sports section than the business section, you'll make more money from share investing. Who believes me? Why? Majority of Australians get their information from the newspapers. Is it a little late?
Yes.
What sells more papers, good news or bad news? So you're more likely to deviate from your long-term investment plan. Who pays money to get live share prices? Costing you money. Get rid of it. Not just for the actual subscription, but what you do with that information. Don't worry about it. Buy quality investments and hold them for the long term. That's what Warren Buffett does. Does anyone want to know what Goldman Sachs share price is doing right now? It was down 50% 3 months later. Now 12 months on, it's up 70% from his purchase price. How important is it just to maintain a long-term view? What about the Australian banks? They did the same sort of thing. They were sold down because people put them in the same basket as the United States Bank. And look where they are now. They've all rebounded. Great buying opportunity. Warren Buffett, is he still buying? Yes, he's backed up the truck. He's buying across the board because he realises opportunities that we're in at the moment only come around a few times in people's lives. And when they do come around, you've got to have a big swing. That's why I invested $6 billion. You look at the time over history. This is the market history from 79. That was the 87 crash. Who here bought at the low after the 87 crash? No one. Best time to be buying in modern era, no one bought. 50% off? None? Why not? Well, I'll tell you why I wasn't. I was 8 years of age. You're 11, that's fair enough. What about September 11? Why not? Who bought in September 11 after the crash? No one. Why? Because you're too fearful to do so. You don't have that excuse anymore. You thought that the market could potentially fall further. When the market looks the worst, it is the best buying opportunity. What about now? Market's had a bit of a rebound. Who's happy to buy now? Who thinks in 3 years' time the market could just go back to where it was trading at in November 2007? Who thinks it could do that? Yeah, it could. Who thinks it's got a fair probability of happening? I can give you 95 reasons why it'll go back to all-time highs. I can also give you 5 reasons why it'll go down. But if that's a 95% probability of going up, I'm happy to actually back up the truck. The other reason that I'm confident that it'll go up is that every time the market has gone down, what does the market continually do? Go back up. So you go forward in 20 years. We look back at the global financial crisis, that correction. Who's going to wish they bought? When you look at the graph and it's on level 40 of this building. That's potentially where it could be in 20 years' time. Why? Companies have got record profit. Consumer sentiment is at all-time highs. Business sentiment is very close to all-time highs. And also in 87, what was the interest rates? When? 20%. What is it now? 3.5. It's an interesting time where we are right now. Throughout history, my time, and studying it before it, there's been no time throughout history where you've got asset prices that are so cheap, yet the cost of funding so low. 3.5% is a bargain. When you overlay those two concepts, this is the time to be backing up the truck and having a go, like Warren Buffett. This is the bear markets in history. Every time the market falls on average, it's 14 months it takes, and it falls on average for a bear market 34.3%. The last 50 years. That's fine, that's a rear vision mirror. Let's look through the windscreen. 12 months recovery, 32.7. Another thing, if you look further into those statistics, every year the market falls further than the average, what does it do the following 12 months? It goes up even more. So 12 months, well actually from the lows, we're 6 months in, or just over. In 2008, because of the global financial crisis, it lasted 17 months, and it fell almost 55%, more than 87. More than 87. Now, many people over the last 10 years of my stockbroking career have said that the market could never fall the way it did in 87. It could never fall like it did. It could only go back up because we've got 9% superannuation going into the market. We've also got more access to information. Investors are more sophisticated today. The market could never go down, but guess what happened? It went down, and the reasons why is because of all those things they thought that it wouldn't go down. Because of superannuation, because of leverage, because the fact that we've got access to information. The speed of the internet, the ability to buy and sell at the click of a finger has cost a lot of people a lot of money because they deviated from their long-term investment plan and hit sell in a frenzied panic. That's 12 months. What about 5 years on? Let's look what happened in history. The last 2 recessions and also the Depression. Many people in February were commenting that this is going to be like the Depression. And looking at these results for the next 5 years, I hope they're right. 5 years following the Depression, 1932, the stock market recovered 367%. 82 recession, 251%. 94, 267. Who would be happy with half that? If you get half that, what about your superannuation? What about your own funds? What about a quarter? That would be phenomenal returns over 5 years. Now, I'm not saying that history repeats itself, but looking at the share market, it generally rhymes. There's a consistent trend to suggest that, yes, we've got pretty good times to come ahead. The market is always forward-thinking. It doesn't look in the rear vision mirror. Unfortunately, 86% of the investors that invest in the share market, though, are looking in the rear vision mirror. Another reason why Warren Buffett is buying right now is because of consumer sentiment. The last time it rebounded from such low levels was back after the 87 crisis. So it's fine, we can look at a chart and look at consumer sentiment, but that's not going to make you money. Let's compare what the market did 3 years following the last time consumer sentiment was at these levels, so we can get an idea of what potentially could happen in the next 3 years. Market after 87 and consumer sentiment was at these levels, recovered 76%. 3 years following it. Who's happy with that as a return in 3 years? Now, I'm just suggesting that the market could potentially go back to where it was in 2007. If it goes back to that level, the market has to go up just on 50%. Now, some people think going up 50% in 3 years, that's a bit excessive. Well, what's it gone up in the last 6 months? 50%. So it's gone up 50% in 6 months. Who thinks that it could potentially go up another 50% in 3 years? It's got 12 times the amount of time for that to happen. For it to happen, it just has to basically perform a little bit above the average of the share market before the last correction. It has to go up about 14% per year for the next 3 years to get to new highs. Can that happen? Yes. What about inventory levels? Another statistic that Warren Buffett looks at is inventory levels. The last time it was back at these low levels, or recovered from these low levels, was in 74 after the oil crisis. Share market 3 years forward went up 273%. These are the reasons why I've got 95% probability and confidence that the market's going to go up in the next 3 years. Possibly substantially so. So Warren Buffett, invest in the share market because it offers the highest potential return. What should you do? Exactly the same. What that means is get all your super money, get all the money you have, back up the truck, even ask your grandma for the inheritance early, and invest it on the share market. Who's confident to do that? This is what sets Warren Buffett apart from everyone else. He has the confidence to do that. He's got 2 rules to investing. What are those 2 rules? Never lose money. Rule number 2?
Don't forget the first rule.
How does he achieve that? Well, he bought a company for $6 billion. Do you think he owns the decision making of that company? Do you think the directors are going to be calling him up for advice? Of course they are. So he controls the underlying decisions of the companies he invests in. Do you have $6 billion to invest in a company? Do you have the capacity to control the decisions of the companies you invest in? Unless you've got $6 billion, which you don't, I don't, just yet. So what we have to do is come up with our own investment philosophy. That investment philosophy, first and foremost, is know what you want. Secondly, model someone who is successful. Third one, do what we do best. So let's follow Warren Buffett. You invest all your assets in the share market to enjoy all the pleasure associated with making money from the share market. Then we have to come up with a risk reduction strategy to minimize the losses on the downside. That's very simple, and you guys have been taught it over and over again by speakers this weekend. What is it? Insurance. We insure our cars, so why don't we insure our biggest asset? Who in the room has more money invested in super or the share market than they do the value of their car? The majority. Why is that the case? Why do you insure a liability but leave the lifetime savings to be a victim of the market? Do you think there's more crashes on the share market than you're likely to have in your entire life owning your car? You've got to transfer it over. Why don't more people insure their shares? They don't know. That's the number one reason. Only 2% of investors and stockbrokers are actually licensed to give advice on insurance. That's a bad starting point. Why else? No, it's not speculating if you're hedging it. You're hedging the downside. I suppose it depends on the term of your insurance. I would encourage everyone to look at insurance for 12 months to 3 years, not 12 minutes. What's the other main reason? Well, usually it's all got to do with a cost-benefit analysis. It's like, yes, sure, I'll have the peace of mind and sleep at night, but what's it going to cost me in the short term? So thanks very much. Hopefully you got a bit out of my presentation. You learned something. Also got an opportunity for an investment. I'll see you around.